Hello everyone, welcome to the Fundamental Analysis tutorial series for Forex traders. Today I have another topic for you, so let's get started. So today we are going to talk about GDP and how we calculate GDP. So what is GDP? GDP is a leading indicator of a country's economy, the monetary or the market value of the finished goods and products, services that are produced within a country's border in a specific period of time. We call it a GDP, that is gross domestic product. The GDP is calculated on a yearly basis as well as on a quarterly basis. And when we calculate GDP on a quarterly basis, we determine whether the economy is expanding, producing more goods or services, or see whether it is contracting or it is decreasing output. It also gives us an analysis of how one country's economy is performing against another country or countries. And a country's GDP takes into account all of the private and public spending and output, investment and net exports. And net exports we calculated while we have total exports minus total imports. Okay, so why GDP is important? GDP is important because it measures economic growth. It gives us a picture of the health and size of the economy, and it steers the direction of the financial markets of a country or regions. And GDP affects economy in because it affects business conditions and investment decisions, and it provides job opportunities and business growth and expansion. And when we have a rising GDP, it tells us about that the economy is boosting, there is an employment increase, and there's an increase in spending, and the businesses are actually expanding. And when we have falling GDP, it shows us that the unemployment is increasing, and there's less production and growth. So, how we calculate GDP? GDP is basically a tool, though it has its limitation. It's a key tool for the policymakers, economists, investors, and businesses all around the world. There are three approaches to calculate GDP. Number one, the expenditure approach. Number two, the production output approach. And number three, the income approach. So let's take a look one by one. The expenditure approach, it is considered better than other approaches as expenditure data is timely available and reliable. And as the name suggests, expenditure, so it's basically takes into account all the expenditure in a certain country. For example, we have a formula for expenditure approach. Gross domestic product is equal to C plus G plus I plus NX, where C is the consumption, or we can say consumer expenditure or consumer spending. G is equal to government expenditure or government spending. I is equal to investment, business, it could be business investment or capital expenditure or private domestic investments. And NX is basically net exports. And how we determine net exports? Exports minus imports. Then we get net exports of a country. Okay, so this was the expenditure approach. Now we look at the income approach. The income approach calculates the gross domestic income, as the name suggests, and it takes into account the factors of production. And we look into all the inputs needed for creating a goods or services, which include land, labor, entrepreneurship, and capital in an economy. And we also look at wages paid to labor, the rent earned by the land, the return on capital in the form of interest, and corporate profits. Sales tax and property tax are adjusted as they are not the payments made to factors of production. So this is the income approach for calculating gross domestic product. Now we have the third one. Now we look into the gross domestic income, the income approach formula, where gross domestic income is equal to compensation of employees plus gross operating surplus plus gross mixed income plus taxes less subsidies on production plus and taxes less subsidies on products and imports. So this is how we determine the income approach to determine the gross domestic product, and this is the formula that we use. Now we have third approach, which is called the production or output approach. And this approach estimates the total value of economic output and subtract the cost of intermediate goods that are consumed in the process, like those of materials and services. It's a reverse of expenditure approach as it calculates the output while expenditure approach calculates the input cost. Okay. All right, that's about it guys. Thanks for watching. I will see you next time.